Hello, everyone, and welcome back to the GMS Weekly podcast, where we break down the key developments shaping the global ship recycling markets.
It's week 25 of 2026, and this week's headline could not be clearer. Peace is signed, but the rains still rain.
Exactly. After more than 100 days of closure, the Strait of Hormuz is reopening.
That is the turning point the market has been waiting for.
It is. The United States and Iran have digitally signed an interim peace agreement, with the memorandum now in effect and a formal signing set for Switzerland.
So, unlike last week, the pen has finally landed.
Yes, last week the pen was hovering. This week, peace has been signed.
And President Trump's message to ship owners was direct.
Very direct. He authorized the strait to reopen, lifted the U.S. naval blockade, and told the world's ship owners, "Ships of the world, start your engines."
That is a dramatic change from the war quarter.
It is. Iran's Supreme National Security Council has also confirmed that all military operations, including Lebanon, would cease immediately and permanently.
So the geopolitical obstruction that kept so much older tonnage trading has been removed.
Correct. But the irony is that the subcontinent, which spent the entire quarter waiting for ships, now has to ask those ships to wait a little longer.
Because the monsoon has taken over.
Exactly. The war has ended, but the beaching window remains governed by the weather.
Let's talk oil first, because the move has been enormous.
Brent crude has collapsed to around $78 per barrel.
That is back near where the war began.
Yes, Brent had climbed above $126 at the height of the conflict, and now that entire war premium has effectively been erased.
WTI is also lower, near $75.
Correct. And this is not just about the strait reopening. The agreement removes sanctions on Iranian oil exports and clears the way for Saudi Arabia, the UAE, and Iraq to restart millions of barrels of halted output.
So the market has moved from shortage risk to oversupply risk.
Precisely. The International Energy Agency, which earlier called the Hormuz closure the largest supply disruption in history, is now warning about a coming glut.
That is a huge reversal.
It is. The oil market has gone from fear to abundance in a matter of weeks.
And for ship recycling, lower oil changes the entire equation.
It does. The bunker cost floor was one of the key reasons older vessels stayed trading through the war. With Brent near 78, that support is falling away.
Freight has also cooled.
Yes, the Baltic Dry Index eased to around 2,653 on June 17th, down from the June 1st peak above 3,200.
And Capesize earnings have fallen sharply too.
Daily Capesize earnings are now around $35,162, down from nearly $49,500 at the late May high.
Still respectable, but no longer at war premium levels.
Exactly. The long-haul disruption that inflated Capesize demand is starting to normalize.
But Supramax and Handysize held firmer.
They did, and that is important because those geared segments are more relevant to recycling candidate flow.
So the big picture is that both fuel and freight are now deflating together.
Correct. The twin forces that kept aging tonnage profitably at sea are finally weakening at the same time.
And that should prime the recycling candidate pool.
Yes, the deferred wave is now building, but again, it is building into the monsoon.
Peace frees the ships, the rains limit the beaches.
Exactly.
Let's move into the recycling destinations, starting with Bangladesh.
Bangladesh enters week 25 with the taka still holding near the floor of its established band, around 122.75 against the dollar.
That currency stability has been remarkable.
It has. The taka held throughout the entire war chapter without breaching its 122.74 to 123.18 range.
Through Brent at 126, through Brent at 78, through the rupee's volatility, and through the peace agreement.
Exactly. The band held through the whole cycle.
What about steel?
Local steel plate prices held at around 65,000 taka per ton, or close to $530 per ton.
So Bangladesh remains stable on both currency and steel.
Correct. And the letter of credit pipeline remains cleared and permissive.
Demand is still there.
Very much so. Chattogram still has full plot capacity, strong appetite, stable financing, and the most resilient currency position in the region.
The issue is no longer geopolitics.
No, the issue is now the sky.
The Bay of Bengal monsoon.
Exactly. The monsoon governs the beaching calendar through August, regardless of how favorable the macro picture becomes.
But once the rains ease, Bangladesh could be very well positioned.
That is the key point. If candidates start releasing through July as the war premium evaporates and the monsoon eases into September, Chattagram could face one of the strongest post-monsoon demand and supply alignments in several years.
So the war could not fill the beach, and peace cannot fill it immediately either.
Correct, but the reason has changed. Before, it was a blockade. Now, it is a season.
And seasons keep a schedule.
Exactly.
Moving to India, this was a big week for the rupee.
It was. India is probably the biggest currency beneficiary of the peace.
USD INR rallied to around 94.60.
Yes, a 5-week high for the rupee, and a sharp move away from the late May record near 96.97.
The oil move matters enormously for India.
It does. India imports more than 80% of its crude, so Brent collapsing towards $78 feeds directly into the external account.
And India's May trade deficit had already narrowed slightly.
Correct. The May trade deficit was around $28.21 billion. Even with petroleum imports still high, the June figures, based on much lower oil, should look materially better.
So the rupee has finally moved from defensive recovery to real fundamental support.
Exactly. The RBI's inflow measures were already in place, including the removal of capital gains tax on foreign investment in government bonds. Now those measures are operating with a tailwind, not a headwind.
But the recovery still has conditions attached.
It does. Shipping and energy flows may take weeks to fully normalize, and the interim agreement still leaves some unresolved questions around the nuclear file and the durability of the wider ceasefire.
So the rupee has priced the end of the war, but implementation still has to deliver.
Precisely.
What about Alang?
Local steel plate prices softened during the week, moving from around 38,000 rupees per ton at the start of the reporting period to around 37,500 by June 19th.
Even with a stronger rupee?
Yes, the post-war collapse in energy and scrap sentiment outweighed the support from currency strength.
In dollar terms, that puts steel just under $397 per ton.
Correct. India remains the lowest-priced subcontinent destination.
But structurally, India's setup has improved.
Very much so. Alang enters the post-war period with deep yard capacity, more than 110 valid statements of compliance, a recovering currency, and a deflating bunker floor.
But the rains still rule.
Exactly. The candidate wave may be forming, but Alang is in the depths of the monsoon. The recovery matters most once the weather allows operations to normalize.
Now to Pakistan, where the rupee remains the anchor.
Yes, USD PKR held near 278.28, sustaining its strongest level of 2026.
Pakistan finished the conflict as the only subcontinent currency to appreciate against the dollar across the entire war span.
Correct. The state bank's 100 basis point hike to 11.5%. Disciplined reserve management and strong remittance inflows all helped deliver that result.
And Brent at 78 should ease Pakistan's external pressure too.
Absolutely. Prime Minister Sharif had previously quantified the weekly oil import bill at around $800 million at the height of the war. With Brent now sharply lower, that pressure is collapsing toward pre-conflict levels.
So that should help the inflation story going forward.
Yes, it removes the pressure at its source.
But peace also changes Pakistan's competitive advantage.
That is the key strategic point. Gadani benefited from the Gulf proximity premium while Hormuz was closed.
And now that premium begins to fade.
Exactly. As Hormuz reopens, as tankers transit normally, and as Gulf production restarts, maritime geography returns to its pre-war shape.
Meaning Gadani competes on price and compliance again, not wartime location.
Correct. The advantage was real, but it was also circumstantial. And the circumstance has ended.
Steel remains firm, though.
Yes, local steel plate prices held at around 195,000 rupees per ton, with the dollar equivalent near $700 per ton.
That keeps Gadani at the firmest absolute pricing in the basin.
It does, for now. 3 HKC-certified yards remain operational, with further certifications in the pipeline, and the RON continues to work through the yard after delivery.
So Pakistan exits the war from a strong position.
Very strong. But the peace period will measure how much of that strength is structural and how much was tied to the wartime premium.
Finally, Turkey.
Turkey remains the outlier again this week.
Because while the Hormuz-exposed currencies strengthened or held, the lira weakened.
Exactly. USD Turkish lira broke through 46 per dollar to a fresh record near 46.15, after touching around 46.44 intraday.
That says a lot.
It does. In the same week that the war ended and oil importers got relief, the lira made a new low.
So Turkey's problem was not really Hormuz.
Correct. Turkey's pressures are domestic and structural. The peace agreement helps through lower energy prices, but it does not solve entrenched inflation.
May inflation remains the operative read.
Yes, May CPI was 32.61% year-on-year, with the official year-end forecast range suspended and the target still held at 24%.
And policy remains tight.
The policy rate is at 37%, with effective overnight lending around 40%.
Does lower Brent help Turkey?
It helps, but only at the margin. A Brent price near 78 rather than 107 reduces imported inflation. That is the best disinflation tailwind Turkey has had all year.
But the inflation structure is too entrenched for oil alone to change the picture.
Exactly. For Turkey, lower oil is helpful, but not transformational.
And Aliaga?
Aliaga remains structurally uncompetitive for mainstream tonnage, with prices around $268 to $290 per LDT.
So Turkey remains an EU-regulated tonnage market.
Correct. Basel Convention compliance and EU regulation define Aliaga's role, not price.
The post-war candidate wave, when it comes, will mostly head to the subcontinent.
Yes, the price differential is simply too large. Turkey occupied a different market during the war, and it will occupy that same different market during the peace.
Looking at the broader picture, week 25 closes the war arc.
It does. Brent climbed above 126 and has now returned to around 78. The strait closed and has now reopened. The blockade lifted. The premium evaporated.
The barrel toured the war and came home.
Exactly. And now, the aging tonnage that stayed profitable at sea through fuel and freight, support is finally facing a different calculation.
Keep trading or head toward recycling.
Correct, but the timing remains classic ship recycling timing.
The ships are free and the beach is wet.
That's exactly it. The deferred wave is being primed just as the subcontinent is deep in the monsoon.
So the immediate market remains constrained.
Yes, but the second half setup is stronger than it has been all year.
Bangladesh has demand and financing.
India has currency recovery and compliance capacity.
Pakistan has firm pricing but a fading wartime premium.
And Turkey remains a regulated niche market.
Peace is signed.
The premium is gone.
The ships are moving.
But the rains reign.
That's the story of week 25.
That's all for this week's update on the global ship recycling markets.
We'll be back next week with more insights.
If you would like to get the complete market update delivered to your inbox, subscribe to GMS Weekly through the GMS website.
And before we close, a quick note for our listeners. On Friday, June 26th, GMS and Capital Link will be releasing a special on-demand webinar marking 1 year since the Hong Kong Convention came into force.
We'll be looking at the progress made in responsible ship recycling over the past year, with industry voices from across the recycling, compliance, and ship-owning landscape.
Until then, stay safe.
And thank you for listening.